Hello and welcome to the market update for January 7th, 2015. I'm your host, Mark Yegi, and today we're going to talk about, very briefly, what's going on in the marketplace. You can see that the market has just gone red, and you can see 1, 2, 3 red arrows, which means a red market in our market timing system. So let's take a look at the market timing graph here today. Today's candle is this trade right here. You can see that the Dow Jones is up about 131 points today. This is the New York Stock Exchange Index, however, and you could say that it's off its highs for the day. And we have 5 big days of selling in a row, pretty high volume days if you want to look at it that way. And the high volume days portend that the fact that there's a lot of institutions that are selling into this Greek exit from the euro, which probably won't happen, but it's the fear that's stoked from 2009 and 2010 again, and that's put that fear back in the market, and it's created this big sell-off. On top of that, you could see that this increase during the green market was on very low volume. So we reluctantly went to green. Our system says that we have to go to green, but it wasn't a lot of volume holding it up. So we didn't jump on the accelerator and say, keep buying stuff in here. We said, be very careful up in this level. And here's why, because if you don't have a lot of people buying, as soon as the selling starts, there's nobody there to hold it up. So what you saw is the 5 days in a row decline on pretty heavy volume. Nobody there to hold it up. And you can see these 5 days took out these other 7 or 8 days on the way up, including this gap up. And now that gap's been filled, so it's no longer a factor. But we have 3 red arrows. So we're walking a little bit carefully here into this market. The market is red, even though it's up today. But it could obviously go up higher. But everything just seems to be pointing that there's a correction coming, and even though it's been pretty minor so far, it's going to continue on. So we call this a dead cat bounce. That's probably what's going on in the market today, and we might get a bounce back up to this standard deviation level here, this solid red line, or this moving average level. And that's generally what happens. The markets like to revert to the mean. However, we have this envelope that we draw here, and about 4 out of 5 times, it might actually be a little higher in the last couple of years, but you could see this circle here, and you can see that I'm going to draw a circle right here, which shows that every time the market gets to that oversold, or in this case, an overbought level right in here, it tends to want to revert back to the mean. This is an exception here, this big V-shaped correction. But you could see when it happens other times right there, boom, it comes back and corrects to the mean, and then there it is again. So we sent a signal out yesterday that said we're probably going to get a bounce today, and that's what we're seeing in the market. Don't know how strong that bounce is going to be with all the volume that we have, but we want to recommend that you do not go long. This is a red market. 3 out of 4 stocks track what the market does, so you're going to be a salmon swimming upstream if you're going to be trying to go long. Best thing to do is be in cash, or if you're a little bit more aggressive, you can hedge or be on the short side. This is a red market, so be careful.